analysis of natural gas is probably going at least to $9. Right now it's $6.
Yeah,
Used
that's
to
a
be two,
big
four,
increase
now
for
it's six.
people.
Now that's going to affect people.
Yeah, absolutely.
And also gasoline prices and diesel prices and heating oil prices are going up. So people, low income, middle income, all of a sudden their heating bill becomes a factor in their life. It pinches them. They have to cut back somewhere else. Food could be impacted next year by what's going on in natural gas this year, because natural gas is a key component in making phosphate and fertilizer. I don't know. I think that what Bitcoin did last summer through the spring of
Okay.
which went from like 6,000 to 65,000.
Wow.
Okay? It did it in 9 months. Okay. Now that stunned everybody. I wouldn't be shocked if silver did something comparable. If you're a gold bug right now, you're looking at gold alone. You shouldn't be doing that. You should be looking at other attributes and not just the dollar either. The dollar is somewhat irrelevant to gold. It has been for the last 5-6 years in terms of gold doubled in price and the dollar went sideways.
Well, welcome back to Risk, everyone. I'm Lee, and I'm here with a special guest, Mr. Michael Oliver. Michael, why don't you tell us who you are and what you do?
Oh, golly. I used to be a futures broker back in the mid-70s when gold was legalized. It was with E.F. Hutton down on Wall Street. Their headquarters were Battery Park. And I evolved out of that business in 1992, and I set up Momentum Structural Analysis. And what we provided and still provide, it's 30 years now, is technical analysis of a unique kind. It's not price chart based. That would be a secondary attribute that we look at. It's our own method of plotting momentum, and we look for structure. What do I mean by that? Well, what I mean by that is the same thing that price charts look for. They look for structure, trend lines, flat floors, ceilings, et cetera, et cetera. But we look for it on momentum as opposed to on the price chart. Because usually it's our experience that I won't say it's 100% of the time, but 90% of the time, momentum will tend to lead price in terms of registering a trend change.
How are you determining momentum?
Well, we measure price action, which is, of course, a very loose goose, because the thing most people measure price by is fiat currency. As we all know, fiat currencies, they quantify constantly. Every decade, they about double. The amount of US M2 doubled about every decade since 1960. Now it's even increasing faster. So the yardstick itself of a fiat currency, like the dollar, is elastic. So you're measuring with something that's very unobjective. What we try to do is take a step from that by measuring price in relation to a moving average. Now, I don't mean an overlay, where you overlay 200-day average or 3-month average on a price chart. It's where we oscillate price versus that average. So, how much above is the S&P above its 40-week average? How much below is it? We plotted it on an oscillator. And we'll look at one of those charts a little later. And it gives us a different view of what's going on. Often a more structured view, one that almost smacks you in the face sometimes, where you don't see it on the price chart, but you see it on momentum and say, good grief, this thing's about to break trend. So we've serviced institutional clients, and in that 2016, we opened up to retail clients. We put out reports that cover all 4 asset categories: debt market, foreign exchange, commodity markets, and stock markets. And frankly, in this day and age, you need to be looking at all of them because they interrelate so much.
Absolutely. I totally agree with that.
If you're a gold bug right now, you're looking at gold alone. You shouldn't be doing that. You should be looking at other attributes and not just the dollar either. The dollar is somewhat irrelevant to gold. It has been for the last 5-6 years in terms of gold doubled in price and the dollar went sideways. But there's other factors out there. Like right now, one of our focus points is on the debt markets, especially the muni bonds and the junk corporate debt, high yield corporate debt. Because as we all know, during the collapse March of last year, February, March, those markets collapsed too. And the Fed came in and scooped them up. In fact, they even bought ETFs, HYG, these are junk corporate ETFs. They bought muni bonds from state and local governments to support those markets. And they bought them big time. And you can look at the charts of those particular markets and see that they've gone up just like the S&P. One difference: they ceased going up, both those critical debt markets ceased going up in price some months ago, whereas the stock market, which they had been in sync with, has continued to rise. Not explosively, but just continued to rise, but they haven't. In fact, they're starting to roll over. In fact, both of those markets we just did a report on are close to breaking levels that we consider pivotal, that could definitely put them back into a downtrend.
You know, I don't know if you noticed last week, but LIBOR spiked up the highest amount it had since the Lehman crisis. So there's definitely some interesting stuff going on in debt markets.
Yeah, well, the Fed is playing a dangerous game. They want to jawbone the debt markets and the stock market, or they think they're jawboning inflation by threatening tapering and rate hikes somewhere down the road. They're going to be watching those two markets I just mentioned. The muni bonds and the high yield corporate debt start to roll over again. They can't continue divesting themselves of those things they bought all during the prior year.
Yeah.
So they're going to have to come to the rescue again.
Mm-hmm.
So everybody thinks they're looking at inflation numbers, but I'll bet they're looking at those muni bond markets and the high yield corporate, because if those start to drop in price, they get a problem again, in which case they can't go tightening.
Yeah, pressure on yields again, right?
Yeah, and I think that will help also any wobbling in the stock market. And we think we're near an inflection point here in the stock market. We think the stock market starts to deteriorate, and there's a lot of skeptics, who are along the market, major asset managers, big name asset managers, hedge funds that own the stock market, that are skeptical for a variety of fundamental reasons, pricing, valuations, and so forth. But they've not divested themselves because they can't. If you get out of the market, it keeps going up, you look like a fool. So, but a lot of them are nervous enough to start reallocating assets, small portions at a time, to other markets, safer places, like the U.S. government long bond market, which is starting to get some strength here. We think it's trying to turn up again in price, drop in yield, something most people don't think is going to happen. We think could happen. Why? Not because the bond market is unaware of inflation problem, but because it's an asset category that's a parking place.
Do you see a steepening yield curve in the near future?
No opinion on that. No, no thoughts on that. But we do think there could be a rally in the long U.S. government bond market. I'm talking not the munis, not the corporates. And it's simply a function of people saying, hey, I'm going to move some money out of this market and put it over here and park it for a while because it's safe. Okay. They're also buying gold. And we think gold and silver especially are very close right now to re-engaging on the upside. Coming out of this congestion zone we've been in for going on 16 months now, since last August. A zone that has confused a lot of people. We have maintained a long-term bullish view on gold and silver. We got bullish actually in February of 2016. Gold was at 1140. We haven't altered that view since. Despite the recent congestion, we think it's just a pause before the next up. And I think the next up could be very dramatic, not just in terms of how much price is gained, but in the rate at which it's gained, especially for silver. We can look at some of those charts later. But as regards gold and silver, you need to look at the stock market, because if it gets wobbly, or if the muni bonds get wobbly and start to break, what's the Fed going to do? They're going to have to cease and desist on this talk.
Yeah.
They're going to have to become friends of the market again, in which case they're stuck. Either keep the foot on the pedal or watch it fall apart.
The plunge protection team has to come out and save the markets again.
So anyway, we think the Fed is really, the central banks of the West are really in dire straits right now, because if they do alter their policy, they're going to see fracturing of these key markets that they can't let fracture. There's too many vulnerabilities out there, like pension funds and municipalities unable to pay their bills, et cetera. They've got to come to the rescue again, regardless of the quote inflation. We've always had inflation. It's just shown up in the stock market for the last dozen years.
As well as the real estate market and
Correct.
Tuition costs. There's a whole slew of inflation factors that the Fed never uses,
No, that's right. Those are factors it regards as okay.
Exactly.
We can look at some charts if you like.
Yeah, absolutely.
It's weekly as of the close of last week.
Okay.
This goes back to late 2018. You can see the rise, the 3,400 in the early 2020, and then the collapse. Then the sharp recovery. But since late summer of last year, August of 2020, the action on the momentum chart got above that lower red line that we've drawn horizontally. And there were two sharp pullbacks to that same line in September, October of last year. Now, what that means is the price dropped down toward the zero line. The zero line is the 40-week average that you see overlaid on the price chart. But when you oscillate it, you get a different picture. Rather than getting this ascending price pattern, you've got this horizontal price pattern where the market keeps dropping. Now it's the third time. 4 weeks ago, we dropped down to that same horizontal lower red line. After breaking the upper horizontal at about 10% over the 40-week, we dropped down to about 4% over the 40-week, and we turned up again. And it's interesting that it turned there because
So when you say turned up, you're talking about right here?
Yeah, at the third arrow.
Oh, down here. Okay.
Third arrow on momentum. We
Yeah.
hit that support line again. Now, you don't see that line when you look at a price chart. We didn't go back and touch the September, October lows, but on momentum we did
Okay.
last year. And we held and turned up. Now therefore we've marked the spot on momentum. That's now a triple bottom. Okay. And if you go through that line, it's called a quadruple bottom breakout.
Okay.
Now, if that were a price chart, everybody would get excited by it because they'd see the vulnerability pending below. You don't see it on the price chart, but you see it on the momentum chart.
Okay.
So right now we're in a rally mode off of that low. That's fine. We suspect there could be resistance around the upper line. Why? Because if you look at that upper red line on the momentum chart, it goes back to December of last year. So it's about 11-month wide line. All the weekly closes from December of last year up through September of this year held at 10% or more over the zero line. In terms of low momentum weekly closes. So that was the structure we broke, and now we're headed back up to bump it. Question is whether you can get above it substantially, credibly, or whether you fail there.
So you're looking for the momentum to get above here.
Well, I'm saying if it gets up to that second line, you got to be real cautious if you're a bull, because if you don't get above that line solidly, that upper red horizontal line, about 10% over the 40-week average. Now, what's the 40-week average? Why that? Well, that's about the same as 200 days. Okay, and it's about the same as a 3/4 moving average. So all those three long-term averages are sisters of each other in terms of duration.
Sure.
Same amount of time, basically. 200-day, of course, is very popular. Well, in the case of the 200-day, if I showed you the chart, I don't have it here, it looks almost identical to this 40-week, where you've got a floor under the 200-day average as well on the oscillator, where you keep dropping, but you don't go down to the 200-day average. You stop about 4% above it, just like this 40-week did, about 4% over the rising 40-week. So it is a structure as well. So what we're looking at now is we think the market is probably in the phase of topping. That the breakage we saw below that upper red line that occurred 2 months ago was the start of the fracturing process. You went down to next support, which had to hold, it held, turned back up. Now, if you fail at that upper line and start back down again, we would bet you better not even touch that lower line. If you do, you're probably going through this time. Now, also notice that we're not making new highs in momentum. Price has been nudging new highs for the last, since summer. We got above the April highs. Momentum hasn't. So momentum's in a weaker position, and it's got structure pending below. And one of our phrases is, you can't break a trend unless there's something to break. Well, here you have the something to break on that bottom chart. So we're monitoring both the 10% over level, which we're pushing at this week, by the way, up closer to 4,600 would get you there. Okay, we're in the upper 4,500s right now. You fail up in that area and you roll back down to that lower red line, we declare bear trend. Now that's this is what you should be watching if you're a gold long, because if this market breaks down, it's a major asset category that's been the beneficiary of the liquidity.
Yeah, absolutely.
Years, okay. If it breaks down, the Fed goes on defensive again.
So basically, we're looking at the potential either way of gold breaking out to the up or downside.
Well, upside. Let's get the gold chart up. You'll see that it's somewhat opposite what we just looked at on the S&P. just like the S&P had a floor underneath it that it's trying to defend on the momentum chart. Gold has a ceiling overhead on its momentum chart.
Okay.
That's the chart at the bottom there. And here we're measuring gold, weekly bars again, in relation to a 3/4 moving average, which is similar to a 40-week. But what we've got here on the gold chart, the momentum chart, is we go back to March of last year. That's where that chart starts. You can see the sharp drop in the momentum chart there. And a low close. It was a low weekly close back in March. It was like about 2.5% under. No, excuse me, about 2.5% over the zero line, meaning about 2.5% over the 3/4 average at that time. That was the low close in March of last year. Remember that sell-off?
Right, right.
Well, the gold exploded. Now, then in November of last year, we had another drop in gold. Took gold price down into the 1700s. And the low weekly close in that sell-off was also at 2.5% over the 3/4 average. So we have two lows that are horizontal on the momentum chart. Begins to establish a structure, in other words. We bounced again into December. And then in January, the momentum chart broke below that red horizontal line. It closed down below that plus 2.5% level on the momentum chart, meaning it broke that structure. And sure enough, gold dropped another couple $100 because the point it broke it was in the mid 1800s. We dropped down to 1670 in the next 2 months by the March low. We thought the March low last year was it. We just put a parenthesis quotes around it. Okay, we thought that was the low of the correction. It's been tested since, but that has remained the low in terms of weekly closes and traded price. But since then, look at the momentum chart. It's rallied up to where? In May, we had a nice rally in gold, took gold up to 1900, which is where price also fumbled, if you'll notice, back in December of last year, that rally up to 19. So even price has set a little double top up there at 1900 on those weekly closes. But momentum has set a line, it bumped that red line again and turned down.
Does it matter that we've been making higher lows as well in the momentum, according to
the momentum is registering somewhat stronger lows than the price chart has. Yes,
Right,
that's
right.
correct. As the 3/4 average has dropped over the last 2 quarters. But now momentum, this is as of last week, by the way. So you can add a little bit to that last reading you're looking at there on the momentum chart. We're pressing up toward that red line again. And you close out any week during this quarter at 1825 or higher, we're going to close above that red line on momentum. And meaning momentum is going to break out over that structure. And therefore, at that point, declare, okay, I'm through going down, I'm through going sideways, and going back up again. Now, at that price level, it doesn't mean too much for the price chart, 1825, because if you look at the price chart at the top, the recent highs back in July and August were 1835.
Right, right.
Not 1825. Momentum breaks out over a year and a half wide structure with an 1825 close, but price still hasn't even taken out those two recent highs. So momentum is leading price here. Now, if you get above that 1835 in the price chart, you're going to wake up some price charts. They're going to say, hey, this is bottom. Okay. They'll really get excited when you can get above that 1900. Now, momentum at that point will already be fully engaged. It's engaged at 1825 weekly close. So momentum's way ahead of both of these structures that you see on the price chart.
I'm assuming silver is pretty much the same case. And what would your target price to get above on silver? Around 25?
Silver has its key level, its pivotal level, comparable to this 1825 gold level, is about 1530 area.
Okay.
So we've been up to there's not 50, 2530. Excuse me.
Oh, okay, yeah, that's right.
The high last.
I say we're a little above 1530 now.
No, we're not that low. The high last week was 2490, so we're talking 1.5% above last week's high, and about the same thing. We're talking 1% above the current high, current trading price in gold, about 1805 in gold right now. So we're literally 1% or so below breaking out upside on both these precious metals, the monetary metals. Excuse me, and we suspect that you might begin to see stock market breakage as this gold chart turns up. Why? Because the money that the Fed has fueled for the last dozen years is seeking a new home, simply because some people view that category as too risky, too overbought, too old. Anyway, we think that gold and silver are very close to engaging back to the upside based on this long-term momentum metric, the 3/4 moving average. And similarly, as we saw with the S&P, it's got a structure below it. on a comparable average, a 40-week average. So both of them have vulnerable structures to engage a trend change. In gold's case, and silver to come out of this congestion zone. In the case of
I've often theorized that if the markets sell off, gold and silver would take a hit as well, but your charts are suggesting otherwise.
no, I argue the other way at this point. The correlation between a weak gold market and a weak stock market is few and far between. There have been a couple instances, for instance, in 2008, where in a very much lagged manner, gold finally dropped from over $1,000 in late 2008 to the high 600s in early 2009.
Mm-hmm.
And which joined stocks at the tail end of the stock bear market, not early. The stock market topped in late 2007. So gold ignored that. But then in that panic sell-off, almost a crash-like mode for the stock market, gold did sell off.
Right.
We're not looking for a crash in the stock market. We're looking for a normal bear market top, meaning arm wrestling match, like most tops are in the stock market. Look at the 2000 top, 2007 top. They didn't collapse. It wasn't until later that you saw anything that looked like a collapse, like late 2008, for example. They engaged in an arm wrestling match that was net negative, but still it was confusing to a lot of people looking at the charts.
Right.
Time it rallied, they felt, oh, it's okay. That's kind of what we're looking for here. But any wobble in the stock market that creates a sense of doubt, even 5 or 10%, or further drop in the muni bond and the junk corporate debt market, is going to have to, I suspect the Fed is going to have to change their tune, rewrite their speeches, change their next speech, put in some new keywords other than taper, because those markets have to be defended. For a variety of reasons that we all know, again, vulnerable pension funds, cities that can't pay their bills, et cetera, et cetera. So the Fed they're walking a tightrope. And if those markets start to crumble and generate any sense of negative psychology, they're going to have to respond accordingly. That may not be further money printing, but although that's an ongoing process anyway, but it at least means they're going to have to shut up.
Yeah. I would imagine we'd probably see some more stimulus money coming out or other kind of support from the federal government beyond.
There's no choice. There's no choice what else they do. They have to defend those categories, even if it means gold takes off. That's just the way it is. Right now, we'd be focused on the energy markets. We put out a report last October. By the way, you've got this on file, by the way. This is a report we put out a year and a week ago, mid-October last year, based on momentum factors. We were looking here at Bloomberg Commodity Index monthly chart going back to 2010. And then there's a 3/4 moving average oscillator below, which where we measure the monthly bars in their relationship to the 3/4 average. And we could see there was a massive downtrend line. It went all the way back to 2010. It was hit 4 times. The 2010 top, 2016, 2018, and again in late 2019. Final drop was in March of last year, along with the stock market. We turned up and Bloomberg broke that line. That was a massive breakout. In fact, that occurred in August of last year, that breakout over that downtrend line. And then in October of last year, he broke out over the red horizontal of the momentum chart, but it fully engaged, in other words. And most commodities, you could throw a dart at, starting from August last year through about October and November. You could throw a dart at any commodity and it boomed. So it wasn't, specific to the commodity fundamental change. It was a broad factor and a monetary factor, we think, where assets said, okay, asset managers said, okay, I've had enough of this stock market for a while. I'm going to start buying commodities and commodity-related stocks. Yeah, because they're a safer place to be. They're not risen for a dozen years.
The smart money's basically rotating into commodities right now,
or stocks, but with the commodity attachment.
Right.
Oil producers or fertilizer companies, et cetera.
Of course.
So it's no surprise from a technical point of view that a year ago we said it would be a commodity explosion, not just an upturn. And basically it's exploded. Crude oil, for example, we got bullish at the price of getting above $40 last year. Natural gas, a little above $2. It's now above 6, oil's above 80, et cetera. But this is true with most commodities. Problem for this year, I think, and this winter, is going to be the energy factor. because as those markets continue to rise, and we think, for example, our analysis of natural gas is probably going at least to $9. Right now it's $6.
Yeah,
Used
that's
to
a
be
big
4,
increase
now
for
6.
people.
Now that's going to affect people.
Yeah, absolutely.
And also gasoline prices and diesel prices and heating oil prices are going up. So people, low income, middle income, all of a sudden their heating bill becomes a factor in their life. It pinches them. They have to cut back somewhere else to cover the electric bills and the gas bills. And the Fed's going to have to notice that. Now, also there's a correlation between strong bull markets in natural gas and unemployment, where major manufacturers, because of heating costs or power costs become a factor in production costs. For the last couple of years, that hadn't been a factor. Energy prices have been so depressed. It's been a non-event. Now suddenly energy prices are on the page again, big time. What's that going to do to HR departments? They're going to get the word from above, say, hey, we've got to slow up on hiring, or we got to taper on hiring. And so that's going to impact unemployment, we think. And we don't think this natural gas explosion is anywhere near over. In fact, it might even go ballistic beyond our $9 swing objective.
That's a really frightening thought. How similar is what you're seeing now to the 1970s commodity bull market?
I think that would, in hindsight, will be viewed as a miniature of what's about to happen.
Wow. That's pretty scary.
Yeah, no, I think in percentage terms now, talking, particularly in some markets. Now, food could be impacted next year by what's going on in natural gas this year, because natural gas is a key component in making phosphate and fertilizer.
Mm-hmm.
And a lot of the fertilizer companies having to shut down. They literally are. In fact, in England, I think CF Industries, which we've recommended buying of many months ago, they shut down to the extent that the British government paid them money to stay open. They're not making money, making fertilizer. Well, what if there's a fertilizer shortage come this spring?
Yeah.
That's going to impact a domino effect on crops next year worldwide. So that these dominoes, they all topple in sequence.
It goes to what you were saying earlier with you have to look at all the markets, and
you have to look at all the markets.
They're all interdependent. And
this rise in commodity creates negatives that the Fed can't ignore. Yeah, they don't like the rising prices, but on the other hand, if they try to fight that, they're not going to have enough energy around, and it has domino effects on unemployment. So if all of a sudden unemployment doesn't get better or start to plateau, like last month's reading was not so great for the Fed, if this coming month, the next month are not so good, then the Fed's going to have to shut up again. Again, part of this could be caused by rising heating prices and power prices. So the rise in commodities is creating factors on this side of the ledger that the Fed has to defend, so they can't taper. So it's an interesting set of dominoes here. And gold, we think, is one of the prime beneficiaries of this set of dominoes, and silver even more so. In fact, we've got a chart of silver and gold ratio that we recently released that is very pregnant with the indication that silver could vastly outperform gold.
Wow.
Technically speaking, silver has been a vast underperformer to gold since 2011 peak. So when silver hit $50 again, back in 1980 peak was $50. It hit there in 2011, turned down.
Right.
And it underperformed gold through about 2019, 2020. In other words, as gold was going up, silver tried to go up too, but wasn't keeping the pace that gold did. Gold doubled, remember, from the late 2015 low to the high last summer. Silver finally engaged relative to gold, we're talking, not this just net price. It broke out on a spread basis, meaning you measure what percent is silver price in relation to gold price. And that spread chart broke out clearly last summer, the same point when silver itself exploded. Silver was trading in the teens, and suddenly it was almost $30 in a matter of 3 weeks. During that time, that spread, the relative silver relative to gold, had broken out technically. Since then, as the process has occurred where gold is corrected and silver's more or less gone sideways in a broad range, that spread is not broken back down. It's gone sideways. So it's still positive for silver. There's another structure, though, on the spread chart that we bumped in 2016. There was a certain relation to about 1.5%. What the price of silver was in relation to gold and that rally that occurred in 2016, that first major rally off the bear low. Then the rally we've recently seen, the spread again peaked around 1.5%. Price of silver versus the price of gold. Right now, it's just below 1.4%. We argue if you ever get a monthly close on the spread, meaning price of silver versus gold, it's much higher, it's credibly higher than 1.5%. Like, in fact, our specific number is 1.53%.
Okay.
You ever get a monthly close with the price of silver at 1.53% of gold, it blows through an entire range of spread readings going all the way back 6-7 years. We think at that point, a similar behavior, by the way, on that relationship of silver to gold occurred back in 1979 during that 1980 bull market in commodities. It also occurred in the run up to the 2011 peak in silver. And at the point where that spread broke out, at that point, both gold and silver engaged in a much speedier upside, which whatever their pace had been, they suddenly accelerated. And in fact, both of the surges, those surges in the spread and also in the net price of both metals, peaked in about 6 or 9 months after that spread breakout. But what happened in that 6 to 9 months after the spread broke out was ballistic. Now, when you go back and look at the 1980 peak in silver and gold, the silver ratio to gold was 6%. Price of silver expressed as a percent of the price of gold. In the 2011 peak, it was 3%, over 3%. Well, that's a big move. When you've got a metal that's at 1.5%, it goes to 3%. That's a doubling.
Yeah.
Not just a 1.5% move, it's a doubling in its relative strength to gold. And that's just getting back to where the spread was in 2011. If you ever go back to where it was in 1980, it's 6%. Silver will be off the page. Even if gold did nothing right now, you do 6% of $2,000 gold or something, you get a big number.
Well,
So,
what do you expect that to be? Like 80 to 100, maybe?
Oh no, we're thinking more like 200. We think,
wow.
First of all, the
Wow.
gold market, even in its prior bull markets the last 50 years, if you go back and trace where the bear market low was prior to each of the bull markets, 1975 bull market when gold was legalized, it had already been in a bull trend for several years, the 1980 peak, the 2011 peak, etc. They were all like 8-fold moves measured from the price low that gold had before that bull market started. Well, what was our recent low? 1046 in November, December of 2015. Well, 8 times that, $8,000. That's just a normal ratio bull market for the prior 3 bull markets. That's not anything exceptional. We think it could be more than that. Well, even if you just went to $8,000 gold and had another 8-fold move, like the prior 3 bull markets.
So you think $8,000 in gold is quite realistic?
I think it's realistic. In fact, it's just a replica of the 3 prior bull markets. And I think we're actually in harsher times, such that we could go more ballistic. We might even see the end of fiat currencies when this is over.
So if gold reaches 8,000, what would your price target be on silver?
Well, I mean, you do 3% of that. That would be silver replicating its relative performance peak of 2011, or 6% of that be replicating its relative performance peak of 1980. It's off the page. So yeah,
what's off the page to you? Which are 200 or
I don't know. I think that what Bitcoin did last summer through the spring of
okay,
which went from like 6,000 to 65,000.
Wow.
Okay, it did it in 9 months. Okay, now that stunned everybody. I wouldn't be shocked if silver did something comparable.
Wow.
If silver becomes the next Bitcoin type market. It's the poor man's gold. And even a lot of the Bitcoin folks, they're recognizing that. They've gotten around the silver concept. And I think it's legit. Technically speaking, fundamentally speaking, I think their concept is correct. And they've learned something. That Bitcoin has been a heck of a lesson for people. It's taught a philosophical point to people without giving them a lecture. And that is that, hey, we don't like fiat currencies. What do we need them for? They just inflate and get worthless and more worthless year by year. Bitcoin can't do that. It's
Yeah,
not,
the Bitcoin community really has promoted the idea of sound money in some way. Whether you believe Bitcoin is sound money in of itself is another story, but they have certainly...
It's certainly sounder than fiat currencies because it has a theoretical limit to expansion rate. And most of the cryptos, that's the case. So they're competing now with government controlled money. And the concept is hit the whole new generation globally. The young 20 and 30-year-olds who are investing now suddenly have shrugged the idea of we don't need government money. Well, if you got that concept, suddenly you don't need a lot of things the government does once you've crossed that line. So we think there's a lot of stuff going on here, that not just markets, but fundamental concepts that is going to shake the world. And ultimately, though it may be violent in the markets and not good for some people during the process, the ultimate end is going to be very Darwinian, very good. We'll have evolved to a better state because a lot of bad ideas will have been rejected, much like this generation rejecting fiat currencies. We'll have stable money again. I suspect you're going to have some governments, quite possibly the Chinese or the Russians first, having a gold-backed currency. Finally, maybe the West will get the idea again. It's been 50 years of this since Nixon took us off gold on international exchange for the dollar, where we went totally fiat. And so people ought to, you don't even have to be a gold bug economist or an Austrian school to look back and say, this 50 years hasn't worked out very well, We created boom bust cycles.
Look at the cost of housing, the cost of tuition at schools, pretty much the cost of any good. It's crazy. I mean, we've had somewhat of an artificial support with goods coming from China and our reserve currency status, but the inflation's there for sure. So talking about inflation, we were talking earlier about energy prices. I would imagine that's going to have a profound impact on the airline industry.
We put out a report today. We haven't done one in a long time with the airlines, but the natural thought is, of course, the airline stocks. There's an ETF called JET, by the way, it covers the major airline companies, not the plane manufacturers, but the airlines. They rebounded from a March low of 2020, just like the stock market. They didn't go to new highs. That's a weekly chart of the airline ETF, and you can see that the big recovery since March last year. But they didn't go back and they didn't exceed the 2019 highs. In fact, they peaked back early this year, this ETF did, about $28, $29 on the ETF. It's now trading around 22, okay? Price charts started to break down already. It's a parallel channel going back over a year. And it's behaving like it broke something. Tried to rally up a month ago, but didn't quite get it to roll it over. And the momentum, this is again that 40-week average concept that we use on the S&P. You can see that the recent low is along the red line we plot. Now that red line is not at the 40-week average or the zero line. It's at about $3 below the 40-week average. This oscillator has made a structure. It was a floor structure back in 2019 through early 20. And when it broke it,
so you're talking about back here, right?
Yeah, that period there, it held that $3 underneath the 40-week average, held. And finally, when it broke it, it fell apart. And then you fought your way back above it after the March low and later in 2020. And in the fall, you got above that structure, and you took off.
And now we're back here.
And now you're coming back down and trying to use that structure again for the third time in the last several months. So you're sort of glued to that support line. Like you tried to rally off of it a month ago, but you didn't succeed. So if we see the jets break below that lower line, we suspect that would occur probably simultaneous with the S&P breaking through its 40-week structure. We suspect the airlines will roll over again. Now, why? I mean, heck, if the COVID is now starting to taper off, and all the numbers show it, it's peaked at a lesser high than it was, 9 months ago. If you look at the deaths and hospitalizations, yes, it was a big surge recently, but it didn't match the previous surge. If you're starting to roll over again, as all the metrics seem to indicate, then we should be buying airlines, right? People get back on planes again. Well, a couple things happened. This is again, dominoes hit dominoes. One, fuel prices now are suddenly a factor for airlines. They weren't a year ago. Airline fuel back then was half the price it is now, just like natural gas and oil and so forth. They've all doubled. So suddenly that's a cost factor for the airlines. But the bigger factor we think might be this. During that process, major corporations, I've read that 20% of airline traffic is business-based or work-based. Mm-hmm. But it's 75% of the profits of airlines, because usually They charge higher tickets for business because they're in first class, et cetera. That's a big cost factor for businesses. They send their guy from their New York office over to their Zurich office or their Singapore office or whatever, in a hotel, got food, got airline costs. Suddenly they learn to do it internet.
Just like we're doing now. There's no
Right now,
reason
but
for us
there's
to-
even I saw on public TV the other day a company's got a holographic
Wow.
internet connection where we could see you sitting in your chair, not just on the screen, but physically looking like you're really there. And you could see me like we're sitting across from each other. No screen, it's a holographic image.
That's,
And they're
that's
telling
like
me
Star Trek stuff there, Michael.
it's really neat. And I saw it, it was amazing. I thought, you know what? Major corporations have learned they've cut their costs of travel and business travel by a lot and save time too. It takes an extra day or so for a guy to go from A to Z and then back, and so he wasted time, not just money but time. They can do it on screen, but if they can do it holographically, and I think this company's charging like something like $90,000. Well, heck, that's nothing for a major corporation to have those facilities built in their offices. That could cut into the business percent of that airline traffic, which is the heavy profit part of airline traffic. So it's not just a matter of energy costs for the airlines have jumped, suddenly become a factor again. It's this business aspect of airline travel.
Well, that is absolutely going to crush the hotel industry.
It would have the same, I would think, the same effect there in terms of what percentage of hotel business based on business travel, and that's going to be shed kicked, and it's probably not going to heal again. You're not going back to the normal rates. You'll come back some, I'm sure, but too many businesses have learned that they can cut costs and be more efficient by communicating the way we are or holographically soon. That could change a lot of things that we assume to be past truths to come back to birth again. They're not going to.
Yeah.
They come back to half-life.
We're seeing a similar impact on the commercial real estate space too. Office spaces.
Yes. Yeah.
Unnecessary in a lot of cases.
Especially in the larger urban centers, where safety becomes an issue and so forth. So a lot of things are changing. They're going to stay changed. And now that energy has become a factor again, that's going to impact a lot of these other variables that we don't think about being connected to energy, like fertilizer, okay, connected to natural gas, and so forth and so on. A lot of these dominoes are toppling out there, changing direction, probably some of them for good. And that instability is going to create pressure on the central banks to not really genuinely change their trajectory.
No, that makes perfect sense. I mean, you're giving a good explanation and insight into intermarket analysis and why it's so important, because one market does not move in isolation.
Correct. And especially the non-solar and non-turbine air generated electricity. They've been demonstrated to have failed to reach their goals in various countries. But Germany's hurting very badly. They've got a lot of wind generation, and they've shut down I think 40% of their coal plants over the last 3 years. Now suddenly they're begging for Russian natural gas. You have India's major cities in India having to shut down for power shortages. It wouldn't shock me if it happens in Europe this winter.
No, we had a similar issue in Texas this year. I mean,
yes,
they got crushed.
Yeah. And suddenly there's a return to the mean of the prior energy sources. Man evolves over time. Let him evolve. Don't have government say, okay, you got to evolve to the rate we say. We've evolved from burning wood to burning coal. Then we shifted to oil, more to natural gas. All of these get less and less carbon related. We've evolved that way. But now suddenly they wanted to speed it up faster than we were really ready to do. And they did it coercively via law. And they've created a crisis. And it's hard to go back to those energy sources that have been diminished and suppressed, like natural gas and so forth, in terms of production. It's hard to get them back online again to compensate for these errors that have been committed. So again, it's these dominoes, and they're all interconnected. And usually the connective point is government. Because government, rather than letting chaos occur, meaning individual interaction occur, which seems to be chaos, but actually it's orderly on a micro level, voluntary exchange, they've tried to homogenize everything. I use the term coercive homogeneity. Whenever they have a policy, they're telling everybody, get in line and do this on this issue. Get in line and do this on this issue, instead of allowing human growth to occur, which sometimes occurs randomly. Major discoveries are not made because government says we need this thing, because some guy invented something we didn't even know we needed.
Yeah,
Like the
yeah,
auto.
very very true. I mean, I always say, the central planners think that the 100,000 of them out there that there are can outthink the billions of people out there and
Most of
out-innovate us. I mean, it's insane.
and most of them never held a job or had a business.
Exactly, exactly. I had a great interview yesterday with Ali Shahadi from Lebanon, and I'll send it to you. It's what a story about the Lebanese lira just collapsing, what he's gone through, the
Mm, mm,
insane, fascinating
yeah.
stuff.
So
So,
it seems negative, but it's really positive, all the things that are fracturing, because when they reheal, they'll reheal in a better way. Because
creative destruction, correct?
absolutely, that's the phrase, yes.
Wow.
And gold is merely part of that, expressing that process where men are reverting back to more solid currency, whether it's crypto or whether it's gold or silver, but they're getting away from fiat stuff because it's degenerating so rapidly that it destroys their lives.
So thank you everyone for joining us here on Risk. A special thanks to Michael Oliver, who was so generous with his time and sharing his charts. Why don't you tell the listening audience or watching audience about what your services are and how they subscribe? And what I'll do is I'll put some links in the description for you.
Well, our website is olivermsa.com. MSA stands for Momentum Structural Analysis. So olivermsa.com. You can go there and ask for samples. There's a lot of explanatory material on the site that discusses our method, why it exists, how it works, past reports, so forth and so on. We have our major subscription is $475 a quarter, $1,800 a year if you go annual. And it covers all four asset categories, as I said, debt, stocks, foreign exchange, and commodities. And in the commodity arena, we focus mostly a lot on gold and silver. We even have a separate report just on gold, silver, and mining, which comes out at least once a week. The other report, the all asset, comes out almost every day. We've also created a Bitcoin report that's very narrow focused. We look at Ethereum futures and Bitcoin futures. That comes out every 2 weeks. That's less expensive, obviously, than the all asset category. But anyway, all these things are linked together. So really, even if you're narrow focused, like if your focus is to trade UST bonds, you got to be looking at the stock market and look what gold does, because T bonds and gold, for example, are in similar link right now to some extent. So anyway, but that's what we cover. Basically everything, and we've done it for 30 years, and we happen to think that the next year is going to be 2022 is going to be historic in so many ways.
Yeah, it certainly looks like everything's lining up that way when you're looking at the charts.
Mm-hmm.
So, Michael, thank you so much again for joining us. We'll talk to you soon.
Thank you much.